Well, thank you very much, and welcome everyone. Good to have everyone joining us here. Before we actually get rolling in here, Amy, I think there's one more housekeeping item. The slides are being posted on the internet, I think. Yes, and I see everyone should see a handout link that Amy has just posted. I think that will continue in chat while we're active. So please feel free to download those now, download those later. But that is hopefully there for your use and your successes. My name is Mel Schwartz. I'm the Director of Legislative Affairs for Eide Bailly, based business-wise in Washington, D.C. Jay Heflin works with me. He is in many ways, I think, really more of our Capitol Hill representative now. I try and focus more on some of the technical issues that arise from recent legislation. So we're going to be turning things over to Jay later in the program to talk about some of the broader approaches to tax legislation that we may see in the future. But before we get to that, let's have one last recap. Well, not one last recap, but a recap on those tax bills that actually have been enacted, have passed the House, have passed the Senate, have been signed by the President, and are now part of the Internal Revenue Code. Whether you can buy a copy that includes those changes or not. Anyone else has figured out how to get one, please email me. I am desperately trying to find a paper version. The two big pieces for this year were the semiconductor bill, which was also the China trade bill, and then what we have called in some of our past presentations, the return of Build Back Better, which was renamed as the Inflation Reduction Act, and which in fact includes a whole panoply of tax legislative opportunities, primarily on, let's call it, the green energy side. There is some of the estimates have been as high as $470 billion over the next 10 years in tax incentives for the taking things in a green energy direction. And certainly, however you feel about that, to the extent that that is an opportunity for your company, for your clients, it is certainly something that we want to make sure is explored at least to its fullest. Let's start with the semiconductor China trade bill. The key here is the new Internal Revenue Code section 48D, D as in dog, which provides for a 25% investment tax credit if you place property in service in a U.S., not just in a U.S. advanced manufacturing facility. Okay, what's a U.S. advanced manufacturing facility? It's one whose primary purpose is the manufacture of semiconductors or semiconductor manufacturing equipment. Place emphasis on the second part of that sentence. This is not just a credit for the manufacture of the chips themselves. It is also a credit and an incentive for the makers of the equipment that then needs to be put in place in order to manufacture the semiconductors. Now, it is an investment tax credit, so it comes when the property is placed in service. Has to be depreciable property, and it has to be for this purpose. All right. What does primary purpose mean? Is that more than 50%? Hopefully we'll have some guidance. Probably a good guide is at least more than 50%. How close to the actual manufacture of a semiconductor do you need to be? I build a plant which makes items that are required, are necessary to go into the equipment that is then itself used to manufacture a semiconductor. Am I close enough to the line? Do we have I exceeded the degrees of separation? The feeling that I have gotten from talking with people on the Hill, as well as talking to at least one person with the Internal Revenue Service, is you have not necessarily gone beyond the line, but you may be getting close to the line. So in the absence of specific guidance, this is something that I think each of us who have clients or who are involved in a manufacturing process that has a limited number of degrees of separation from the manufacturer of the semiconductor itself, it's probably worthwhile to figure out whether or not we are potentially qualified, and then be able to react to whatever guidance may ultimately be issued by the Internal Revenue Service. Important. This is an introduction of the direct pay concept for credits. And this is something that we're going to see come up again in spades in the Inflation Reduction Act. But let's just take a minute to go through, because they essentially used the same direct pay concepts for semiconductors that they will then duplicate when we get over to the green credits that are being included in the Inflation Reduction Act. It's an annual election, but it is not due until the extended due date. What does it do? It essentially treats what would otherwise be your credit as a payment of estimated tax. So when you file your return, the amount of taxes that are treated as paid include what that credit would be. And the idea here is, without regard to whether your limitation, whether or not you would be regarded with limited as a result of your taxable income, of your otherwise tax liability, you get the benefit of this credit. And essentially what it's going to say is, when you file your return, you will reflect this. Potentially, we don't see the forms yet. It may be on a separate line. It may not be on a separate line, and we'll need some form of almost footnote disclosure to indicate what we're doing. But it will be there. It will be treated as a payment. Problem is, it's going to be treated as a payment that is made as of the original due date of the return. So it does not appear that this is going to offset any of your estimated tax obligations. So in the case of a business or even an individual who is required to be making paying estimated taxes, we may need to continue to make what would otherwise be the estimated tax payment and not actually get this back until we file the tax return. And I think that's really a failure to how direct pay was structured in these provisions, because if it's going to be treated as a payment of estimated tax, why isn't it a payment of estimated tax at each of the quarterly periods? But and it may still end up being more effective for the IRS to process it that way, and that at least creates some possibility that we would be given that as a treatment. But if you look at the statutory language itself, then it does not. You are not treated as having made that payment until the due date of the return. Partnerships and S corporations, any kind of flow through. Well, they specifically mention partnership and S corporations. The election is made at the entity level, and the IRS is going to pay the entity. Now, does the entity have tax liability? Well, no, probably not. Hopefully not. IRS is going to cut the check, and it's going to cut the check within the period that it is normally allowed to refund excess tax payments. one problem that we see developing, and hopefully we will see some better guidance so that we don't see right now. If a direct payment, and that would include the payment to the partnership and the S corporation, as well as a payment to a C corporation or to an individual, any direct payment that would not have been allowed, for a credit that would not have been allowed, not because you didn't have enough tax or enough income, but because you didn't have enough basis, your partner did not have enough basis, or your partner was passive and does not have passive income to offset here, because after all, it's a credit. We're going to need to go through that passive calculation. Does that potentially make some portion of the payment subject to what they call the excess payment clawback, which essentially says, you know, if you got money that would not have been allowed for this taxable year, you got to give it back. And by the way, there's a 20% penalty that you put on top of that. Notably, there is no carry forward provision that is associated with this. Is this a flaw in the way that the excess payment and the way the structure for pass-throughs has been constructed? Certainly, I think the ABA, the AICPA are moving towards providing a very loud scream with regard to this, because it does really raise some questions as to how effective this is going to be in the pass-through context. Again, the IRS has just barely begun to sit down and try and write rules for this, write rules for other things that we're going to discuss in a minute with respect to the Inflation Reduction Act. We will know more in the future. At this point, I think this is something, though, that you be conscious of. Again, because direct pay primarily relates to credits that are going to be available for activity and for property placed in service after 2022. We're talking about the extended due date for the 2023 return. So unfortunately, the IRS may have a good excuse not to publish much in the way of guidance for a while, but it is something to be aware of, to take into account, and to think about how, if you want to make this election as they pass through, how you are going to handle the potential problem created by the excess payment clawback. Moving on, let's talk a little bit about the Inflation Reduction Act. I think we have talked in the past about the revenue raisers. If you're a $1 billion corporation, welcome to the return of the book tax alternative minimum tax, and we're going to leave that at that. There is a new 1% excise tax on what they call net stock tax buybacks. The key here is, are you listed? Now, listed includes if you've got a 4-letter over-the-counter symbol, you are listed. So this may involve some smaller taxpayers than we originally thought. There are some detailed rules that deal with this. I think we're more likely to see this come up in the context of perhaps reorganizations, but this is certainly something you want to keep in mind if you become involved in reorganization that is ultimately going to involve a C corporation. This is for C corporations only. This is not a pass-through provision. Bottom line, keep in mind that the Superfund tax that was extended earlier to everything but petroleum has now been extended to crude oil and petroleum, imported petroleum products. The fact that you are a user of one of these things does not make you subject to the tax, does not make you responsible for the tax. It is if you are the producer or the importer. That is the person that the service is going to look to for the payment of the tax. Let's talk briefly. Oh, polling question popped up, so do take a look here. This is well, this deals with your inbox, so I do make a point of answering this one. The one, in many ways, the most important change that was included on the green side was the extension, retroactive extension of the production credit under Section 45 and the energy credit, the investment tax credit called the energy credit under Section 48. Those had expired for at least some activities at the end of 2021. This goes back, it picks it up for 2022 and continues through 2024. Now, that doesn't seem like a particularly long extension, but there are other, this is something of a placeholder now, where this is teed up for a complete review sometime probably after the 2024 election. And how that develops was something that we'll have to all keep an eye on. But for the time being, this is here. It's mostly the old rules with regard to Section 45 and Section 48, except that we're also now going to introduce the conformity to wage, hour, and apprenticeship rules, plus, at least in the case of Section 48, which remember is an investment tax credit, is not a production credit where you're generating electricity from an alternative source and selling it, which is what 45 is for. There's an additional 10% available on top of the 30% Section 48 credit if you meet a domestic content requirement. Domestic content requirement here, we'll get into the details a little bit later on that. Also, there's another 10% that may be available if your facility is being placed in service in a designated community. Designated communities in this case are primarily going to be focused either on a fairly limited list of low-income communities, or probably more frequently an area which has recently seen a coal mine close or has recently seen a coal-fired power plant close. It's all done on the basis of census tracts. Certainly when you're considering what the ROI, return on investment, would be with regard to one of these projects, it's going to be worthwhile to figure out, where are we? Where's it located? Are we just talking about 30%? Are we going to talk about 40%? Are we potentially even going to talk about 50%? Because we can meet those bonus standards. Carbon capture. This is a interesting area. The technology is still fairly new in this area. It had not been, there was a significant increase in the amount of the credit. This is a production credit. It's how many tons of carbon you capture and either sequester or you use for some other commercial purpose. Previously, the credit per ton was frankly not high enough to generate a lot of activity in this area. At the new higher amounts, we are beginning to see significantly more interest in this, particularly in situations where whatever your production process is releases carbon. The original use of this provision a number of years ago was somewhat focused on the idea of capturing essentially carbon from dirty electric power plants. That is still kind of a high cost approach, and it's not always clear. But when we get into things like the production of ethanol, we're beginning to see in the production of concrete activities that just by their nature release carbon. We're looking to see a situation that goes through there. Clean fuels. If you were qualified for clean fuels under the old rules, you are qualified for clean fuels under the new rules. Keep in mind that even if your basic biofuel production is not qualified under those rules because the usual ethanol, the standard ethanol production is no longer qualified for that credit. But the second generation biofuel credit is there. We are seeing more and more companies in the ethanol space looking to this, and it is definitely a credit that is very doable. You need to run through some hoops with the IRS, but it's worthwhile doing that. You need to do some additional evidence gathering, but it's something, it is there. If you are interested in making sustainable aviation fuel, you are now going to be included in the clean fuels pot, so on and so forth. Oh, let me go back and mention before, with regard to the Section 45, no, not so much the Section 45, but the Section 48 renewable energy credit. The biggest change here, perhaps, was the addition of biofuels, the use of biofuels to generate captured methane may be a fairly significant change and new opportunity in this section. Again, there are standards that you have to meet, which probably, at least what we've seen so far, essentially mean the methane you capture has to be of a sufficient purity that you could sell it. Most of the people that we have talked to that are in this area are comfortable that they are capturing, or at least capturing methane at a significantly higher concentration than the statute requires to qualify for the credit. But that is, again, something that if you have bio waste of really any type, then it is, and you have a way of, it used to be, if you have a way of capturing the methane that would otherwise be released, we can potentially get a credit for the additional equipment that needs to be placed in service for that. Let's go on. Here we go. 179D and 45L. I think we went into fair depth with this in one of our earlier presentations. We're going to be going into depth with regard to the details here. If you had a 179D opportunity, or even one that you might even have considered in the past, it has been significantly enhanced, as has the 45L credit for building, and that's the builder credit for energy efficient homes. Definitely worth taking another look, and one, making sure that you've claimed all that you can claim, and two, determining whether, well, you know, maybe it was not worth going through the process of figuring out what the credit might be in the past. Under the improved situation, it may be time to take another look. The clean vehicle credits, there has been a fair amount of controversy with respect to this, as to, because there's so many bells and whistles that were put on it that it is not clear how easy it is going to be for the automakers to achieve this. Rest assured that they are working to try and either get the rules changed or to figure out how they are going to meet the rules, because it is a nice credit. It does phase out on more expensive cars and for wealthier taxpayers. Note, and this is, I think, really in many ways the important part, previously, if you got a clean energy vehicle credit, or bought a clean energy vehicle, it was you, the purchaser, who had to calculate the credit. Beginning in 2024, there's going to be a system in place that simply allows the dealer to take the credit. You sign the credit, there'll be a line, you sign it, turns over to the dealer, and the dealer will, the idea is the dealer can now reduce the price by the amount of the credit, moving the obligation for filing the credit and filing for the credit from the purchaser to the dealer, which I think is, as most of us deal with Would you rather file your health insurance claim yourself, or would you like the doctor's office to send it in? I like the doctor's office to send it in. This takes that situation and sort of applies it to the purchase of energy cars. If you're going to buy an energy car, you got to figure a way to refuel it, to recharge it, and so the ability to get a credit for that is the amount that you can spend now is substantially increased, which will facilitate the the location and the introduction of public recharge stations. But with respect to somebody that might want to put it in their house because they saw the Ford commercial, and they like this idea that if the lights go out, they can run the electricity for the house off their truck, in the idea that, yes, the cost of including that bi-directional feature is also going to qualify for the credit. A couple of things, and I think we'll try and move on from the recitation and the details of this. 48C is back, and a new 45Y production credit is coming. The idea behind 48C, as was the case with the 48C that we saw a number of years ago, is it should not just be the production of the energy through alternative sources that is rewarded. It also needs to be a reward for making the things, or building the factory, or expanding the factory that makes the things that we need for the other green incentives to work. So this is sometimes referred to as the windmill credit. And unfortunately, it is not entirely a taxpayer directed credit. There is a cap. Now it's a big cap. It's $10 billion, but there is a cap on this. And the Secretary of the Treasury is going to have to certify. You're going to need to file with Treasury, and they will need to certify your project in order to get a part of this credit. And we don't know. There are indications of what the standards are likely to be. Where is it located? How is it going to work? How likely is it that what you're proposing to do is going to work? Is this something that sort of in the general public interest, the Secretary of the Treasury decides we ought to do? So it's not just going to be a matter of, yeah, we think this is good, we'll deal with it when we get to the tax return. We're going to have to be preparing, and I think we're going to have to be preparing essentially to make our case that we get a piece of this money with respect to what we propose to do. We saw this in connection when 48C was in effect earlier on. It was very, very similar with regard to what it was intended to cover. It had a much lower cap, and the IRS ran out of money. They were not able to certify 100% of the cost of all of the projects that were ultimately submitted. Some of the earlier submitted projects had a better result than some of the later submitted projects. And again, I think that there was also, as time went on, a more and more emphasis on the detailing the kinds of things that the Internal Revenue Service could judge as to whether or not that particular project, that particular taxpayer was going to receive a piece of the pot. So it's a great credit. Certainly it can significantly affect the cost and the ROI with respect to doing this kind of production. But it's one that's going to require some additional work to take into effect. if you don't get your 48C credit, there is a manufacturing production credit that comes afterwards. And this is, you know, instead of a credit for the machine that's going to make the windmill blade, this is the credit for the windmill blade itself. And it extends well beyond that. There is a multi-page laundry list of items and actual amounts that it relates to in the legislation itself. If you are in this business, then certainly, or if you even may be associated or thinking about getting in this business, it's certainly worth sitting down, thinking through what you're doing, what you have, and where it goes. Now, with regard to, another polling question, let's not forget our polling questions. With regard to these credits, pretty much everything that came through the Inflation Reduction Act, in order to get the full amount of the credit, you have to meet wage and apprenticeship requirements. And there are two ways to meet that. Well, actually, there are three ways to meet that. If you're a very, very small electricity producer, you're de minimis. We waive you.
The wage and apprentice requirements are actually in the midst of being written. And so we just basically have to wait to find out what's going to happen. Okay, we talked about a lot of this. One thing I would like to mention about the fuel credits. A lot of cars aren't even eligible for these credits. You basically the country that we work with on these cars have to have a free trade agreement with the U.S. And for example, the Congo is a huge supplier for materials for the car battery. We do not have a free trade agreement with the Congo. So there's you might get questions from people, especially if you're a car dealers. Hey, these people are coming into my dealership saying, hey, I want to buy this car, and they have to literally find out if that car is eligible for these credits. So that could be a little bit of a hiccup. I'm also going to fast forward through these a little quicker than Mel, because I just want to get time to talk to some of the other stuff. Okay, so we're going to look at what might happen later this year. Any tax legislation that's going to happen is going to be tied to the funding bill. What I mean by that is Congress needs to approve money to the federal government so it can keep doing its job. We are right now on the verge of the federal government running out of money, and Congress is working on that right now. And there's basically two options that can happen, and that they center around funding the U.S. government, but that also means that Congress can do other things as well. And so option one, or scenario one, is going to happen on Friday. The federal government runs out of funds on September 30th. Currently, the Senate is about to vote, and I mean in 5 minutes, the Senate is about to vote on legislation that will extend federal government funding to December 16th. Now, there's other things in that bill that are not tax related, but they thought tax provisions could ride on that bill, and it just wasn't going to happen. The biggest reason for that is because there is an ongoing battle between the political parties of the child tax credit and the research and development tax deduction. And what the issue is that one side wants to extend and expand the child tax credit. The other side doesn't want to do that and wants to expand the research and development, make it expense instead of amortizing. So that argument basically brushed all tax proposals off this current funding bill because they couldn't get an agreement on it. There was a lot of things that got cut from this bill. You might have read about the permitting that Senator Manchin wanted, which would basically be that the government would speed up the permitting process for green energy as well as oil and gas permits. That was taken off the bill because Democrats didn't want it. So what we're looking at now is the Senate is going to pass a bill expected to pass a bill by on in about they're going to start voting in about 5 minutes. They will. It's expected that they will pass this bill. The funding will go until December 16th. The House then has to act on this bill. The House is expected to act on this bill tomorrow, on Friday. It is expected to pass way before the midnight deadline that would happen. That's when funding expires. And so President Biden will have to sign this bill into law before midnight Friday, or we have a partial shutdown of the federal government. What I mean by that is every time you hear the word, we're going to have a shutdown of the federal government, what they really mean is a partial shutdown of the federal government. The Army doesn't go on pause when the federal government's not funded. So it's more things like the things that get closed are parks, or things that the statues, those areas might be closed down during a shutdown. But us defending ourselves would never go away because the federal government doesn't have the money. So right now what we're looking at is extending federal funding to December 16th. The House is supposed to pass that. Once the House passes it, every lawmaker will leave Washington, D.C. to go campaign. And there might be a hiccup in mid-October. The Senate might come back, but a lot of people are doubting that they won't. These people are out there for their lives because they're running for campaigns. And we'll talk about this later. It's very iffy on how things are actually going to come out. So the second scenario will come for tax legislation after December 16th. And what I mean by that is lawmakers now will extend funding to December 16th. They have to come back before December 16th to extend the funding again. Now, there could be a big fight with that because based upon the outcome of the election, one party might be more inclined to extend funding throughout the entire fiscal year for Congress, which is October 1 to September 30. So they would want to extend this funding to September 30, 2023. Another party may not want to do that. So how long they extend funding will be a question, but they're going to be in town, which means the lawmakers could actually get together and pass a bill that would be extend a few of the tax provisions. Now, again, this will rely on if that fight between the child tax credit and the research and development tax credit has gone away. Elections have a way of easing partisan divides, and they can work together. It also has a way of worsening partisan divides. We're not going to know how that happens or what happens until the election and to see how the lawmakers perceive it. And I'll go into that a little more in a bit. But here we are. So if one example of how will lawmakers feel and will they want to work together is if they felt like they were victorious in the election. Now, that doesn't mean that you kept the majority of the House. What could happen is that, for example, the House Republicans are expected to gain 25 seats. Well, what if they only gain 15 seats? That can embolden Democrats to say, hey, people listen to our message. We need to push forward on this. And so they might say, we're not going to pass a tax bill unless you expand and extend the child tax credit. So that's one episode. They could also be really beaten and felt defeated by the election. And so they're like, wow, well, the House Republicans got 15 seats. Well, they're still the majority. What are we going to do? Let's just fold. If they fold, they might actually agree to not extend and expand the child tax credit and actually allow a business-oriented tax bill to advance forward. Again, we're not going to know anything until we really test the temperature of what lawmakers feel and how they felt after the election.
All right. Well, I think as Jay points out, what's going to happen in the election really not only is going to control what's going to happen in the future, but may even control, or in years to come, but may also control what is going to be happening with respect to the end of this year as well. Let's just very briefly take a look at where things stand, this is a estimate that is developed by a group called 538, and they run a number of tests which build in different variables with the idea that here's the percentage chance of each party winning the House of Representatives. And as you can see, a week ago, the number was 71 Republican, 29% chance for the Democrats. This morning, they came out with a new calculation. It's now 69 Republican, 31 Democrat. So this trend of the two items coming back together is still in play. However, it does still seem that the more likely result than not is that the Republicans will emerge with control of the House of Representatives at the end of the election, or at least when they seat the new House in January. The Senate, on the other hand, is still extremely up in the air. Essentially, the 6 states that you see in the tan are at this point still considered toss-up states. If you really want to push, probably you would say that there is a small lead for the Democrats in 3 of them and a small lead for the Republicans in the other 3, which, if that is the case, since the ones that we do have a color for or are not up for re-election at all, leaves us at 47-47. If they split 3 and 3, the situation that we found ourselves in this year will not change. The Democrats would have the ability to pass legislation if so long as they only need a majority vote, because they have the vice president to break the tie. Every Democrat, any Democrat who decides that they are not going to support the party line can crash the party line. Of course, because of the filibuster rules, unless the filibuster is itself is going to be affected, getting something to a vote will be require 60, which will require more Republican help than maybe is there. That really, I think, leaves open the idea of, okay, so what can we find anything in this crystal ball as to what post-election outlook might be? And I'm going to turn things back to Jay for a discussion of that, given the let's start with what happens if we see a divided House. If the House goes Republican, the Senate remains in Democratic control, even if it is the current 50-50 split with the vice president for Democratic. What do we see for the next couple of years, perhaps, with respect to tax legislation?
So this outcome where one party controls one chamber and the other party controls the other chamber is the expected outcome of the election. Now, this can change because elections have always been kind of iffy, and polling has not really done well recently on to say who's really going to win and who's really not going to win. But if the House remains divided, and that doesn't mean not the House of Representatives, but if we have a divided Congress, if one party controls one chamber and the other party controls the other, it's going to be very hard to get through tax increases. The Republican Party will be against that. That will not happen. The main question is, well, what about the tax cuts? Can anything like that happen? Well, that is more likely than not compared to tax increases. So if we have a divided House, when it comes to taxes, the most likely legislation coming forward would be something dealing with tax cuts and not a tax increase. Now, and this is the most likely scenario. Now, that also means that there's probably going to be few tax bills happening. I know we saw a whole slew of them here recently, but that may not happen in the next Congress, obviously based upon the election. So if Republicans sweep, which means that the Republican Party takes the House and the Senate, they will and I've talked to Republicans, they are going to, first of all, pass a tax extender bill that would include fixes for R&D, the interest deduction, and possibly other provisions beside taxes that increased or that expired a year ago, possibly last year. I mean, 2 years ago, possibly last year, and maybe a year in advance. They would like to do that as soon as possible. Now, you might be thinking, well, there's still a Democrat in the White House. Well, he may be open to that because of the economy, that maybe the economy needs tax cuts. But the bigger issue is that he was vice president when everything happened to when President Obama actually said, I'm against the Bush tax cuts, and then extended them for 2 years, extended all of them for 2 years, which took everybody by surprise. Let me move forward here with these things. Mel, are you touching the, let me move forward here. And so what we can have is a president signing a bill that Republicans put together. That is not out of the question. So if Democrats win both chambers of Congress, what we're going to see is the House passed its Build Back Better bill late last year that included several tax increases on trusts, on businesses, on wealthy people, and you would see all of those bills come forward. Now, that would pass the House. Now, the thing is, if there's a sweep with the Democratic Party, they currently have 50 seats in the Senate. If there's a Democratic sweep, chances are they're going to have at least 52 seats in the Senate. If that happens, that means that the 2 senators that were against tax increases, that made everything stop that the House passed, would no longer have their power. That basically the Senate Democrats could pass a bill that only requires 50 votes without them. And if there is a Democratic sweep, chances are the Democrats are going to gain seats in the Senate. And if that happens, what we could see is a repeat of the reconciliation rule bills or a Build Back Better bill, where basically they use a budget rule to pass a bunch of tax increases, and Biden would definitely sign that into law. So it's once again a wait and see approach. We don't really know, how things are going to happen, but you basically can expect that a bunch of tax increases are going to happen again if Democrats win the majority, and that will make them feel really good because they're not supposed to win the majority here by history. It's very few times that the party in power in the White House wins the midterm election for Congress after that election for being elected into the White House. So it's very doubtful, but there are some polls out there saying Democrats in the Senate could pick up 2 seats. So it's a wait and see situation. So here are some of the things that could come out of the bill if they did like a very quick thing. But again, to make these provisions happen, the expensing of R&D, the expanding of the 163J deduction, so more can be a part of that deduction. To make those things happen, there has to be an agreement with Democrats that the child tax credit can be expanded and be extended and beyond what it was in 2021. Well, Republicans have already said we're not going to do that. And so once again, like there is bipartisan support to have R&D costs be expensed. There is bipartisan support for 163J to be expanded. There is that thing. But Democrats are saying, yes, we support those things, but only if you modify the child tax credit the way we want it. And so once again, we're in a wait and see moment to see what actually happens. But these the R&D expensing and the expanding the 163J interest deduction are the big ones that Republicans want to move forward. Let's see how if they have any sort of political capital after the election. But those are the ones to watch to see if something's going to move. And so now we are on to this. This is the retirement bill. Oh, we have a polling question. So this is the retirement bill. It's called Secure 2.0. And the House approved its bill back in March. And then the Senate was supposed to pick up on it quickly, and it didn't. The Senate Finance passed its portion of the bill in June, and the other Senate committee, I'm blanking on its name, passed its bill shortly after that. But the bill has not come forward to the Senate chamber to be voted on, and it's unclear exactly what provisions will be in that bill because we haven't seen the legislative text. Now, there's a backstory to this bill, which is that a lot of Congress people are actually retiring who wrote this bill. And so you've got members on both sides of the party who support this bill, who want it passed while they're in office. Well, their office ends on January 3rd of 2023. And so oddly, this is the most likely tax bill to pass the current Congress, which ends on January 3rd, 2023, of all tax legislation. And so many of us are waiting just to find out, when are you moving this bill? Now, it's going to take 60 votes to actually pass this bill. And chances are there's going to be no tax increases in this bill that aren't already in it. There are timing shifts with the House bill that could, be equated to a tax increase. But by and large, the bill that passed in the House passed by unanimous consent. That doesn't happen. And the bill that passed the Senate Finance Committee was unanimous in support. So you could look at those things and say, well, this thing's going to fly through. And the question is, why has it not? It should have. Why is it not moving? But it's not. And so now that with lawmakers about to vote on a spending bill today and tomorrow and get it out of town as soon as possible, the only option is to do this bill when either the Senate comes back in October, which is very iffy, or in the lame duck session after the election. And so once again, it's a wait and see. But of all the tax bills happening that are in Congress, this bill is the most likely to pass in this Congress for right now. That's even beyond the extender bill, which is looking unlikely to pass this year. All right. So Mel, are you there? You want to talk about this?
Yeah, no, I am here, and I apologize for the problems before.
No problem.
As Jay has said, we don't actually have a piece of legislation to look at and say, here are the provisions that are going to be in the legislation if it turns out Congress does take the opportunity to vote on it. Certainly, if this carries over until next year, then legislation would have to be reintroduced anyway. There do seem, however, to be a couple of agreed upon movements. One is for those automatic retirement plans that are treated as safe harbor because they have automatic contributions. There is likely to be a provision that would increase both what the employee default contribution is and somewhat accelerate the employer match. There is a lot of interest in trying to essentially force people to participate in some form of pension plan through their work. And this is trying to push more money into that. With regard to some of the reports, some minor things that might otherwise have to be dealt with, the idea of simply allowing a plan to self-correct any inadvertent violation is something that has been discussed, and there does seem to be general support for. As well as if an employee is claiming a hardship distribution, so be it. Just let the employer or let the employee certify that. We don't want to involve the employer anymore in trying to jump through that hoop. For very small employers, they have been discussing some expanded incentives for establishing plans, including a plan, the ability that the new retirement plan credit, extending that to not just individual plans that are created by employers, but also multi-employer plans that may be set up under the provisions of Secure 1.0 that were there on a on more of the individual basis. The idea of further increasing or delaying the point in time in which required distributions take place out to age 75. I think this was in many ways a selling point for the legislation, but in the Senate, they ran into revenue concerns. And so in order to essentially take any revenue loss of this out of the legislation, out of the 10-year window that they use for calculating revenue effects, they delayed it until 2032. Whether that would still be the effective date in any bill that's ultimately considered, we do not know. But the idea of continuing to push farther out the date at which required minimum distributions are made does seem to be. And as another revenue make-up provision, the idea that catch-up contributions, the additional amounts that can be contributed to an IRA or 401k plan by an individual that has reached 50, and then further catch-up contributions by an individual that has reached age 62, that might have to be made on a Roth basis. In other words, no deduction going in, but no tax coming back out. Now, that is likely to be hideously complicated in the context of a IRA or 401k, a deductible IRA or 401k plan. And the hope, at least, is that something that would simplify, if this is going to be left in the bill, something that would prevent every deductible plan from becoming a blended deductible, non-deductible plan will ultimately be put in place. So that is covers the what we know, at least, of the details that might be there. We've got one last polling question for your CPE. Want to thank you for having been here. Remind you that we are going to have a deeper dive purely on the technical basis of some of the Inflation Reduction Act provisions. And if there are any questions, please go ahead and submit them, or if you prefer, send them directly by email to either Jay or I, and we will do our best to answer them. Let me turn it then back to you, Amy.
Awesome. All right, guys. Well, thank you so much for attending today. Thank you, Jay. Thank you, Mel. We hope everyone has a great rest of their day, and we will talk to you guys next time.